Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Gina Martin Adams warned us yesterday that yesterday's rally did not give her too much comfort. I think I'm saying it safely. Based on her models, they're data dependent. Her view and concerns about the equity outlook has not changed. So let's just see what her thoughts are today. Gina is, of course, Bloomberg Intelligence Chief Equity Strategist. Did I say it right?
That's right.
All right. No, but did I say your warning was right?
Yeah, it's close. It's close enough. You know, it's minute to minute these days, Carol. So
how do you make sense?
Yeah.
Like the rally yesterday, right? It wasn't.
You came in, you basically shook your head at the rally yesterday and you said, anytime we see a move up such as this, it's not a good thing.
Yeah.
And you pointed to 2008.
Right.
And you said, sure enough, the superlative was going back to 2008. You reminded all of us the market did not bottom until March of 2009.
Yeah. Yeah, this is something we did earlier this week, is just looking at these major capitulation moments in the S&P 500 and put them in context of what's happening in the fundamentals. And what you do find is that the big sell-off, VIX spikes, capitulation moments, whatever you want to call it, in the midst of economic distress tend to happen way earlier than the ultimate bottom occurs. Whereas you can use things like capitulation, VIX, pairwise correlations, whatever technicals you love to show capitulation. You can use those for timing bottoms when the bottoms are a little minor 10% corrections that are not necessarily affiliated with major economic distress. But the simple fact that we're in this period of extraordinary uncertainty, and our other models, our more fundamentally oriented models, are telling us that the economic downside has really yet to be fully priced in the S&P 500, that kind of context would suggest to us we could be in for a more extended period of volatility, even if the volatility never reaches the levels that we got with Liberation Day.
So even though we're like off our lows, I mean, like how are you thinking about like how we end up today and what's important coming off of yesterday's rally?
I think the most important thing to watch right now, frankly, is fundamentals. I think that the market is going to be volatile. I think it's going to jump around. It's, I wouldn't be surprised in any given day if we're up 5,000 and down 5,000.
The VIX kind of tells us that, right? A little bit?
Hold on. Say that again. Up what?
5,000 or down 5,000 on the Dow, not the S&P 500, which of course is at 5,000. It's a huge move.
That's a huge move.
Yeah. So I would not be surprised to see extreme volatility because our sensitivity levels to any kind of policy movements right now are enormous, right? We saw that yesterday. What I think we want to keep our eye on now is what are companies telling us throughout this earnings season? Are they going to start pulling guidance, because that's usually a sign of pretty extraordinary uncertainty? How are they navigating this crisis? Are they planning to push costs onto the consumer? And then further, are they starting to change their operations in response to the tariffs that are enacted?
We've kind of heard that that's happening already. We heard CarMax and Delta this week. Amazon CEO Andy Jassy said, and I'm going to get this, I'm not looking at exactly what he said, but the gist of his comments were, we think that producers will pass along the increased cost to consumers. That's happening.
Yeah, and I think they'll try. And then
what do you mean try?
I think they'll try to put those prices out on the market, but will the consumer accept those prices?
Right, if you don't buy it, right?
Or also, is there a substitution, right? I think that this is very interesting in the context of China in particular, which provides an enormous amount of our consumer-focused goods.
Is there a substitution there?
Is there a substitution? Does the consumer have to take the price? And then the consumer only has so much disposable income to go around. What are the alternative categories that they have to cut back on in an environment of accelerated price? Because we know wages are only growing at a single-digit pace. Tariffs are already coming in at 26% on average. That's a whole lot faster than wage growth is, and especially for the lower-income consumer, could be very, very meaningful at driving the ultimate pie and how they slice up that pie of income in their spending.
Bank earnings.
Yes.
What are you going to be watching out for?
Oh, I think this is going to be really interesting because we've seen such a tightening in financial conditions. Our sector strategist, Mike Casper, runs a macro model of financial sector earnings. And one of the things that model told us earlier this week is to expect financials earnings to be about half as much as consensus is anticipating. That's in terms of a growth rate. So some sensitivity coming for financials because we've seen such tightening in financial conditions. So what does that mean? What do we look for then? How tight are financial conditions, and are banks starting to prepare for a downturn? Because you would see loan loss provisions accelerate. You would see bank sort of lending get tighter. You would see them talk about the credit quality, what's happening with delinquencies and default rates. Those sort of indicators are things that we want to watch for in the banks specifically.
Well, we got a little clue, right, from Jamie Dimon being on Fox and talking about the prospect of recession.
What about basic day-to-day movement of customer funds, what they're doing with their debit cards, what they're doing with their credit cards, how they're doing paying this stuff off?
Yeah, I think that that's a great point because you can get a lot of that data now in today's world of alternative data.
Yeah.
You can get a lot of that.
You don't need to wait for the banks. You don't need to wait for Bank of America or Brian Moynihan to tell us what's going on there.
How are consumers actually handling this situation? What are they spending on? You could get that out of MasterCard data. You could get that out of all kinds of second measure data.
Are you seeing anything of concern there?
You know, I haven't looked in the second measure data that's available on Terminal. It's something I'll put on the to-do list, the laundry list of to-dos. It's something we should definitely do in advance of the consumer sector earnings season, especially. I think given that tariffs really just got implemented, we're at the point where we can start to really follow that data series. But it's not something, I have to admit, it's not something we've really tracked too much.
You do follow the economic data. So what's the next data point you're thinking about here?
Oh, God.
I know earnings, obviously, but...
So we have consumer prices and producer prices this week. We're sort of in the midst of getting those indicators out now. I think the Fed is going to be absolutely critical to watch. What tends to happen in the sequence right now is the market starts to acknowledge that recession risk is real. They start to follow the earnings numbers, and the analysts will mark down their expectations. And then the market will feel so lost and confused that it starts to look to saviors, right? It looks to the Fed, and we've already seen how the market looked to the White House as a potential savior from this. I think the market will start to really push on the Fed, and how much will the Fed be able to respond in the environment of inflation and growth is going to be absolutely critical. I think the job market is also really, really interesting right now. Challenger layoffs are at levels we only usually see in recession experiences already. So we're getting the layoffs there, but we're not seeing it in the non-farm number. Why are we not seeing it in the non-farm employment? Why are we not seeing it in the unemployment rate? Some of it, I think, is just survey. Some of it is we're still creating some jobs to offset those layoffs. Will we see job creation then start to slow? And will we also ultimately see the unemployment rate start to rise? Because those are really key triggers for the Fed.
I'm going to ask you the question that I asked you yesterday, but a day has passed and we have new data.
Yes.
Are you more or less concerned today than you were when you walked in yesterday?
Oh, I'm still very concerned. I don't think it's changed a whole lot.
It hasn't changed at all.
I think if anything, the only thing that I can say is at the very least, it does look like we had our panic. Our major first big capitulation event has happened.
Yeah.
I mean, does that make me feel really better that we won't have another one? Not necessarily. I think that this whole the tariff situation is just incredibly uncertain. We still have average tariffs to contend with of 26%. Even if it's 10% on everybody, that still is a big sea change for the economy to contend with.
That's what we were thinking about. Or we had some guests yesterday. Maybe it was you too, who just said, look, let's not forget 10% in any given environment. Tariffs would be a big deal.
Yeah, huge deal, considering we're coming from an average tariff pace that had been close to 3.
All right, we're going to leave it there. Gina, thank you. So appreciate it. Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence, our go-to every day in terms of the trade.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, Ryan Dietrich has been a U.S. stock optimist and right about his market and recession calls over the last couple of years. He nailed it in 2023 and 2024. And when we talked to him in December, he said the bull market had more room to run. So given the volatility and the declines that we've seen, including today, it's time to check in with him again. Ryan Dietrich is a chief market strategist at the Carson Group. They've got about $42 billion in assets under management. He joins us from Cincinnati, Ohio. Ryan, are you still bullish?
Boy, first off, thanks for having me back. We are. I know it's been rough. I know we did not expect to see a near bear market this year. I know I came on with you guys earlier this year and said maybe we could get between 10 and 15% correction after not seeing one all of last year. But clearly, with everything like everyone's talking about,
and we got a 19.99% correction.
Yeah, we were close. And intraday, I know we were there. We can get into a lot of the different things here, but I think the key thing that we're really stressing is, yes, we still think stocks are going to do okay when all is said and done this year, but to be diversified. I know it's kind of boring to say, but just yesterday, right? We manage a lot of money, right? Just yesterday, we actually went into a little bit more international stocks. We specifically like Europe here. We think when times of stress and uncertainty, you want to be diversified. We have some bonds. We've had some gold for a while. We've had gold for 2 years now.
Okay,
but it wasn't quite as popular. So be diversified here when things are like this.
But at the end of this year, do you see the S&P 500 having a gain or a loss?
No, I'd say a gain, and that's really unique because we were just down 15% for the year not that long ago. Mm-hmm. You look in history, when you're down at least 15% at any point during the year, it's kind of rare. You're looking at like 82, 2009, and 2020, and I think by memory, that might be about it, years that we're down at least 15% for the year to come back to positive. But we can get into the weeds of it. There's so much negativity. We think with any potential good news, we saw what happened yesterday. Do we go into a recession or not? It's still our base case, no. But again, we get all of the worries. Now let me just touch on one thing. I know you guys like talking about technicals here. Yesterday, if you look at the NYSE, New York Stock Exchange, I've got data back to 1980 on this. If you look at the volume, up versus down, it was 68 times up volume versus down volume. That's a record. We've never seen a day with that much up volume versus down volume. What does that mean? Well, listen, you're talking like August of 82. You're talking like March of 2009. Those are some other times we saw days like yesterday, which kind of tells us the sellers went on strike. And I know the sellers came back a little bit today.
Wasn't a lot of it short covering yesterday?
Yeah.
I mean, this is what we've talked about with our team. I mean, there was a lot of short covering going on, no?
You're exactly right. And that's how bottoms start. We hear that every time. It's short covering, and then it tends to go a little bit further. But
it's not a fundamental trade. It's not like you're, okay, I'm buying this because I think, their earnings outlook is great. It's, I got to cover my short.
Yeah, you're right. And for the shorts, that's true. But again, what's the market do, right? Right, Carol? It's all what's baked. And by the way, you said it feels like Friday. I think Monday morning felt like Friday, didn't it? It's just like, when is it Friday around here? But anyway, what's baked in, what's not. I mean, there is all of your guests have pointed these things out. Huge put to call ratio spikes, over the top negative sentiment, rightfully so. I mean, look at the headlines, and it's been unfortunate what's happened for a lot of investors. At the same time, we're stressing your best days of the year tend to happen around your worst days of the year. So if you just sold because you had a 10% drop Thursday and Friday, then boom, you have a 9% bounce just yesterday. I mean, that's some important things to remember. And again, to us, what's being priced in is so over the top negative that there's probably still more, a good deal more upside, to be honest. Maybe it's not going to happen tomorrow, but when we look up and avoid a recession, we think things are still going to be okay when all is said and done this year.
What changes your view? What would have to happen between now and, let's say, 6 weeks from now, when you come back on with us and I ask you, Ryan Dietrich, are we going to end the year with the S&P 500 higher or lower? And you tell me lower. Why are you going to tell me that?
Yeah, that's a great question there. One of the things I really like to follow are the credit markets. I know you've had a lot of good credit guests on, last several weeks also. When you look at spreads, right, keep this simple, triple B spreads, high yield spreads, they are not anywhere near what they were in 2022. So if the smartest people in the room, and I grew up thinking this, is the credit markets, they're not as worried right now about a monster under the bed as what the stock market is. It's shocking. Honestly, it's shocking to me right now. Year to date, high yield corporate bonds are down about 3%. If you were to say the stock market's done what it's done with the headlines we've seen, I would expect to see more stress in high yield corporate bonds. But we're not seeing that. Now, that can change in a hurry. Okay. We get that. But I think if the credit markets really spiral out of control, Tim, that's what would worry me. And we're not seeing that as of today, knock on wood.
We do have a headline that crossed around 220. U.S. leverage loan funds seeing a record $6.5 billion weekly outflow. Just wanted to throw that out there. The thing is, we had an economy that was doing well. We were still dealing with a little bit of inflation. Yep. We know the game in town right now is concerns about tariffs. And if we stay at 10%, as most people have assessed, Ryan, that is a tricky thing. It's, any other moment in time where if we just impose the United States 10% tariffs on all of our trading partners, that's a problem. So if that stays in place, what does that kind of problem look like in terms of the equity trade and the corporate earnings trade and the U.S. economy?
Mm-hmm. Yeah, you're right. I mean, it's the uncertainty factor, right? I mean, obviously, we got the decent news yesterday with the 90-day kind of punt, if you will.
But the 10% is still in place.
It absolutely is. And again, nobody, for the most part, thought 9 days ago that we'd be here where we are when President Trump held up that little piece of paper with all those countries, all those numbers on it. We zoomed in and realized, oh my goodness, this is an effective tariff rate of maybe 23, 24, 25%. But you're right, it's all about art of the deal and going back and forth. But the truth, again, that's why we're getting this kind of revaluation, right, of markets. Why we've had one of the quickest corrections we've ever seen. We were almost in a bear market. I'm with you, but again, I mean, you have to think the resourcefulness of the U.S., the ingenuity of the U.S. If we just know it's 10%, then I think we'll be okay. We can get through that. Yes, if it's over 20, Carol, that's not going to be good. We've all talked about the consumer confidence levels, small business confidence levels. People are just confused, and when you have uncertainty, this is what you have: a sell first, ask questions later mentality. We just need a little more a positive news on this trade front like we saw yesterday. It doesn't have to be majorly positive news, but I think it's just some decent news. And one more thing on this, look at the labor market. I know this can change in a hurry, but we initial claims today wasn't all that bad, right? The labor market is still hanging in there. Yeah. So it's hard to have a recession if you're not laying off a bunch of people. Now, we get it. That can change.
That can change. And I should note that we did just speak to Gina Martin Adams on our Bloomberg Intelligence team, chief equity strategist. And she noted that although the claims are holding up and non-farms are holding up, she's seeing some weakness when it comes to the Challenger Grain Christmas numbers that is concerning to her. I do want to remind everybody where we are in the trade today. The S&P 500 was down as much as 6.3%. It's bounced off those lows. We're down 3.5%. The NASDAQ Composite down 4.4%. The Dow down 2.63%. The Russell 2000, those small caps, down about 4%. Ryan, to kind of go with Carol's point when it comes to tariffs, you love talking technicals. But at what point in your view do fundamentals overrule technicals? Because tariffs aren't technical. These are fundamental, and this is now affecting companies here in the U.S. So at what point do fundamentals overrule technicals?
Yeah, I grew up with the old saying, news trumps charts. Trump's being the key word there. So we know news matters. And I mean, believe me, from a macro point of view on the Carson Investment Research team, we look at technicals, valuations, and fundamentals. So fundamentals are clearly in there. It's going to be really interesting. I mean, get your popcorn ready, right? When we got these banks coming up tomorrow, right? We've got a lot of companies coming out. I mean, it's really unique what Delta just said. Delta said, we're not going to give you any guidance because we don't even know what to say. I mean, so that's really interesting that's what that company's doing. How many other companies are going to do that? We'll have to wait and see. But I'm anxious to hear what corporate America has to say here, Tim, about kind of the future.
Too.
One other thing, I mean, I'm sure you guys talk about this, the dollar. I mean, the dollar action. I mean, this is one of the first crises we've seen in our lifetime, most listeners' lifetime, where the dollar did not get a bid. People did not flock to the dollar. So listen, I truly don't know what exactly it means. Is a dollar losing reserve currency status? I'd like to think not, but it's really unique what we're seeing with the dollar being this weak. I mean, last comment here, March of 2020. Gold down, stocks down, bonds down. Dollar was the only thing that went up the first half of March 2020, and we're really not seeing that dollar.
So what does that tell you about this environment? If we're seeing gold surge, but a weakness in those other areas that you mentioned, what does that tell you?
Well, again, I'm going to put my investor hat on, my portfolio manager hat, because this is what we just did yesterday. And we've been talking about this for a while. If the dollar's weak, you want to own some international exposure. You want to have some international stocks because they tend to do better in a weak dollar. Yes, a weak dollar does a little better for commodities on the whole, but specifically in our tactical models, we've had a 4% allocation to gold for, I think it was March 31st of 2 years ago when we added that, so almost 2 years ago. So there are some things that you can do okay with a lower dollar. Also, one of the things we just added again yesterday in the money we run, low volatility. Low volatility, if you look at that, it's pretty much an ETF that has everything really except for tech. I mean, it's like the high flyers. And that is up 1.5% on the year. I'm not saying that's spectacular, but compared to where we were, so low volatility, international exposure, maybe some commodities, some gold. We've got some managed futures too. Yes, we are still about 74% or so equities in our unconstrained models we run. So we've got some equities, but when you look at what we have in equities, it's not just, crazy over-the-top aggressive stuff. There's some other things like low vol that we still like here, Tim.
Hey, Ryan, one thing I want to ask you, and you mentioned international equities, and you said Europe specifically. I'm looking at our Markets Live blog, and it talks about how U.S. equity valuations have fallen more than their peers today, extending their decline since January 20th. And they talked about the rally yesterday was full of strange distortions, with traders ignoring the fact that the overall level of tariffs in the U.S. hadn't changed all that much, a reality that seems to be registering now. But when you do look around the world, you mentioned more in Europe. Are you looking to possibly even increase that exposure overseas at this point?
Well, given we just increased it a little bit yesterday, Carol, probably not quite right now, but I will say this. I mean, I've done this for 25 years, and for 25 years, I've heard Europe is cheap, right? Developed international is cheap. Well, sometimes you're cheap for a reason, but again, we've seen Germany came out, maybe 6 weeks ago with kind of the big bazooka, really trying to use a lot of fiscal policy to get their economy going. There are some things that, again, in times of uncertainty, you kind of want to diversify, and that's, again, just why we've moved a little bit more into international, specifically Europe. Now, EM, just quickly on EM, we're still not too warm and fuzzy about EM. We're still not, I know China had a big bounce, but it's rolling back over. So we'd stick more developed international, kind of the European side of things versus emerging markets,
Hey, one thing I want to ask you, flows. What are you seeing in terms of flows in and out right now, or over the last week or two or a couple of weeks?
Yeah, I mean, a good deal of outflows. I mean, there's been a good deal of worry still. I mean, there truly is some panic in the air. We know that. I mean, the VIX is the one we like to talk about. I know you guys like to talk about it. We just had the first VIX spike above 50 in a long time. I took a look, like when you have that initial VIX spike above 50, like the last 6 times going back like 20 years. Well, not surprisingly, 1 and 3 months later, it's volatility and honestly some weakness. But 6 to 12 months later, you tend to be pretty strong. One more on this. We had, as everybody knows, a really big up day yesterday. I found 23 times the S&P was up at least 5% in one day. So those are like the best days we've seen. And yes, a lot of them took place in bear markets, and nearly all of them took place beneath the 200-day moving average where volatility kind of reigns. Still, when you look at those 23, 6 months later to a year later, you're talking some really solid returns. 1 year later, S&P's up 91% of the time, a year after.
But were we in a tariff trade war?
Yep. Well, I mean, hey, listen, some of those took place in the great financial crisis. Some of those took place during the flash crash. I mean, yeah, I totally get what you're saying. But a lot of times when we all are worried and then we price in all this negativity, Carol, maybe we can get some. I'm a glass half full guy. You know that.
I know. I was going to ask, have you ever been a bear? But I'm not sure.
I've asked him that before, and I think you have been.
Yeah, I mean, we can be more neutral. Honestly, we manage money. We have models that we have to have certain allocations to equities, right? So I can't just say go all in gold. But we totally can position things a little more defensively. And honest to goodness, when I came on with you 2 years ago, we had more growthy things. We had more aggressive things. Now with the money, with the equities we own, like I'm talking, I mean, we've got some low volatility in there, So that's not something we had 2 years ago.
I think what Carol's asking, and it's a question that a lot of friends have actually been asking me, people who are not in the markets, in and out of the markets, they're just like normal people with 401ks and who have investment accounts, is this time different? Yes or no?
Well, the 4 most dangerous words this time is different, Sir John Templeton. Here's what I've done. Every 15th, I put a little money in my kids' 529s. I actually put a little bit more in. Right, my 401k, I actually try to put a little bit more in. I have no idea when this is going to bottom, but if you don't need that money for 5 to 10 years, the old saying, the stock market's the only place things go on sale. Everybody runs out of the store screaming. There's a lot of that. Okay, so there's some really good companies you can get a lot cheaper that everybody probably loved 8 months ago, and who knows where they're going to be 3 months from now. But I think if you're longer-term investors out there listening that have time, this is going to be a time we look back and say, wow, Liberation Day was not fun. That was not a good time, but boy, I'm glad I didn't panic. And one more little cheeky one, plans are useless. Planning is everything. President Eisenhower, have a plan, stick with it. And a lot of people, unfortunately, don't stick with their plans when you have scary headlines like this. And we get why, but then you look back and you realize, oh my, I should have probably stuck with my plan.
Yeah, provided the long-term outlook or the economic outlook, the U.S. economy hasn't changed fundamentally as a result of maybe long-standing tariffs. Like, there's so much at play here, because we've heard from some super smart people like yourself, but also like Howard Marks, who's saying that, there could be certainly longer-term impact because of the tariffs and the volatility that we've seen in the markets. Hey, so glad we could get some time with you. Ryan Dietrich, he's Chief Market Strategist at the Carson Group, joining us there from Cincinnati.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
market. We've got a great next guest who's got a global view, has seen a bunch of market cycles. With us is Mike Siegel. He is a partner at Goldman Sachs Asset Management, serves as global head of the insurance asset management and liquidity solutions businesses, as well as co-head of the client solutions group in Asia Pacific. You do see a lot. Also with us as Bloomberg TV global finance correspondent Shonali Basak, who actually brought us Mike. So we're so grateful because there's so much going on, Mike. And we want to dig into your specific worlds, but you do watch everything globally. And I'm assuming everything is connected. You watch a lot of different markets at this point. Let's start with the environment. We had one auto parts CEO describe it to us as the great financial crisis, the COVID shutdown, and the auto strike all rolled into one, at least for him specifically. How do you see today's market environment?
Well, Carol, thanks for having me, and thanks for that question. I think that people are clearly on edge and are reluctant to make any significant decisions until we get better clarity as to where the tariffs are going to end, where that situation is going to end. Once we have more clarity to that, you can then go back and see the markets will react, they'll adjust, the Fed will react, it will adjust, and so will companies in terms of how they're going to invest, including my insurance clients and including the liquidity clients.
We don't know how it's going to end, but I'm curious if you've mapped likely scenarios for how they'll end. What do you think is going to happen?
Well, we do map scenarios, and so first I'll stick with the insurance industry, which is very well capitalized and not levered in the sense that they're not over their skis. They don't hold a lot of equities on the balance sheet, so the equity market volatility that we've been seeing is not creating a capital strain. They are primarily fixed income investors, and by the way, we're seeing the intermediate and long end of the curve rise. We're seeing credit spreads widen. So on reinvestment, that's a pretty good situation, as long as it doesn't continue to cascade into something much more significant. Yeah.
It's good for the longer term, for people who are reinvesting in bonds. You have insurance clients that are holding long-term bonds, and 10-year, 30-year notes are really blown out at this point. Are they suffering through a lot of pain because of it?
Yeah, so Sonali, you're absolutely right that on a mark-to-market basis, these bonds have lost value. But most of these institutions don't have to report on a mark-to-market basis. They're able to hold their bonds to maturity. So really, they are more benefiting from the ability to reinvest at higher yields than what's been happening to the current holdings. Not the same thing being true for hedge funds, example, or other institutions that are marked on a daily basis may have to provide collateral as their asset values are dropping. But that's not the case for the insurance industry.
But do they feel that there's a certainty that this does get resolved sooner rather than later? I think I love your interview you did with Boaz Weinstein, who I thought was assessing the situation and saying the thing is here we have a president who's in for just under 4 years here, and that he said the uncertainty genie is out of the bottle. So do we continue to, in your view, and you've got to think about short term, longer term, medium term, that uncertainty will be with us throughout this tenure?
I think uncertainty will be with us, hopefully not at the level that we have right now. And again, it's are companies in a position where they're forced to act or not? And to the extent that they're not over-levered, they're not forced to act, they could sit, watch, and look for opportunities. And I could tell you...
Are they nervous at all?
Oh, absolutely.
Okay. Keep going. Sorry.
So I would say, when you game plan out, right now this has primarily been an equity market event. Concerns that it becomes a bond market event. Rising yields are not that much of a problem. Draining liquidity becomes a problem. So there's a concern or a watch for that. Also, I would say for our insurance clients, they are long-term holders of corporate debt. How are those corporations going to fare? And certainly some corporations are going to be much more affected by tariffs, which would weaken credit. Others are immune to it. So we and our clients are doing a lot of work right now, going literally bond by bond, security by security. What is the sensitivity to the tariffs or not?
Well, on a micro level, some of that uncertainty has already led companies on a case-by-case basis to pull guidance. CarMax today, certain financial goals that it's just not giving. Delta earlier this week. You mentioned a lot of uncertainty, and I know yesterday Goldman Sachs rescinded its call for a recession this year. Are you seeing signs of a recession?
So let me say this. So one of the things we want to talk about was the survey. First, I would say on the insurance survey.
It's a 14th annual global insurance survey, 405 companies representing over $14 trillion in balance sheets assets combined. That's a lot.
That's a lot. It's about half the global industry's asset base. I bring that up because one of the questions we said is, what are you concerned about? And that question they got absolutely right. They're concerned about inflation. They're concerned about geopolitics. They're concerned about tariffs and market volatility.
Welcome to our world in a nutshell.
What they didn't get right, and nobody did, was the magnitude of the tariffs and the implications for that. So they didn't see recession this year. That view is changing, including at Goldman Sachs and within our clients. They thought the equity markets would be well-behaved, not rip-roaring, but well-behaved. That view is changing quite dramatically. But they also thought that rates had peaked and would be coming down slowly, both at the short end and the long end. And I still think that that's the prevailing view. So this backup in longer-term rates is looking like an investing opportunity. Mm-hmm. None of our clients have been selling or directing us to sell on their behalf. They are looking for opportunities to get into the market, but they're not in a rush. They want to see how things settle out. Once they see how things settle out, then they'll know where to put capital to work.
You mentioned that you're looking bond by bond right now. And the reason that's so interesting to me is because you're already seeing somewhat of a capital markets freeze. And if you're worried about corporate debt at all in this environment, what does it mean for the way people have confidence in investing in corporate debt in the future, in new issuance, for example?
Yeah, so Sonali, that's really going to be industry by industry, case by case. And that gets back to this uncertainty. Mm-hmm. Until we know how this unfolds, and it may not unfold to a point where we have definition, this is the way it's going to work. You've elevated the amount of uncertainty, which is elevating the amount of risk. I need to get paid a bigger risk premium to hold any of these instruments. And that's why we see credit spreads widening out.
A lot of people are saying this is also a golden opportunity for, while public capital markets are freezing, to look at private capital, because you're seeing these private credit giants just float right in as the public markets are closed. But are you concerned that there's still a lot of pain under the surface in private markets, given that, they call it the denominator effect? These companies are seeing their public portfolios really shrink and their private portfolios therefore become a bigger proportion of their holdings.
So let me take that question break that into two parts. One is the underlying asset values themselves. And so we've got private equity, we've got real estate, we've got infrastructure, we have private credit. At the moment, we're not seeing any of this flow through to the existing investments that have been made, but we have to see how things unfold. And if we end up in a deeper recession or a deeper recession, that's going to weaken the underlying asset values. Now, the thing you said about the denominator effect is the ability to put new capital to work. And there's two components to that. One is I already have a private equity portfolio. I was hoping to get realizations, give me fresh cash to put back to work. And if the public markets are closed, particularly the IPO market, you're not going to see as many of those realizations. So I'm going to be keeping more of my capital tied up in those assets. And then the second point you're making, which is more applicable, quite frankly, to pension plans and sovereign wealth funds, is as the public assets, particularly the equity assets, decline in value, all of a sudden my exposure on an asset allocation basis to the private assets has increased. Again, reduces my willingness to invest more. So
because this was supposed to be the year, right? That all of a sudden we could tap the public markets, sell some assets, IPO, whatever, right? Or M&A, and it
this was supposed to be the year. It is only April.
Okay. So you are hopeful that it gets better?
Well, I'm always hopeful, but we shall see.
I guess I'm just saying in an environment where if we expect more uncertainty over the next 3.5 years, that makes it tricky, right?
It makes it tricky. I think, right now the administration is in the middle of trying to rebalance trade through tariffs. At some point that will settle. Mm-hmm. And then the markets can assess what does it all mean. And then I think you will see markets open up again. You'll see more flow of capital.
We're talking about the risky stuff. But I'm also wondering, you have one of the biggest money market businesses in the world under your purview. So how are those behaving? What are they being used for in an environment like this? Because it's generally safer than a lot of the debt markets that we're talking about.
Yeah, so Sonali, we manage over $700 billion of short-term liquidity products. We consider that to be the canary in the coal mine. So we're always watching what's happening with flows there. And at the moment, things have been very stable. The vast majority of the assets are government assets, short-term Treasury bills, et cetera. And we don't see flows coming into that market. We take that as a good sign. Another part of the market, which is called prime, includes a lot of commercial paper and other short-term debt of corporations. And we don't see companies moving out of prime. So at the moment, and we watch very closely, things feel calm at that end of the market.
When money leaves your money market funds, where does it go?
Well, over the last several crises, if I could say it like that, it's been actually coming into the money market funds. Basically, the two competing forces would be bank deposits and money market funds. And, some of the crises have called into question, creditworthiness of banks, so it comes into the money market funds. If people are very nervous, it's going to go into government money market funds. So primarily T-bills and other government guaranteed forms of debt.
Are you calling this a crisis right now?
No.
Are you seeing money coming into money markets?
No, as I said, we're watching on a daily and minute-by-minute basis, and we haven't seen any flows come in, unusual flows, nor have we seen flows moving out of prime into government.
Guys, by the way, every single crisis for the last decade or so, Mike has been one of my first calls, which is exactly why I wanted to bring him.
How's it going?
Sonali, I hope that's not why you called me in today.
Is any money going outside the U.S.? Increasingly?
You've seen, coming into the beginning of the year, it looked like the U.S. economy was going to be the fastest outside of China, the fastest growing economy in the world.
Exceptionalism, right? We talked about American exceptionalism.
And you also saw the dollar strengthening over a long period of time. So if I took foreign money and put it into the U.S. market, I had probably a underlying market that was going to rally, and I pick up the currency appreciation, a double whammy. Right now, the dollar's weakening and the U.S. markets are selling off. So I'm sure that that's putting a damper on those flows.
I want to go to China and specifically the U.S. relationship with China. You spent a lot of time in China. You live partly in Hong Kong. You're co-head of the Client Solutions Group in Asia Pacific. Is the relationship between the U.S. and China broken?
That's really not in my bailiwick, but I will tell you our relationships with the government entities and the companies that are there, between our firm and those entities is very strong. What's playing out is just playing out above everybody's head, and we're leaving it to play out at that level.
But it has significant implications for the way that companies do business with one another. If one country has tariffs that exceed 125%, if it exceeds that, that's a big deal.
It's very important for the two countries to have good relationships, and then that translates down into the entities that we work with and the relationships we have with them.
Can I ask you one last question? Oaktree Capital Management co-founder Howard Marks wrote today that Donald Trump's tariff policies have the potential to be the biggest economic event of our lifetimes and warned that reversing them could still have consequences. Do you agree?
I don't know if I agree with that statement, but I will say this, that volatility has a cost. It's undermining, people's confidence to invest, whether it's corporations building plant and equipment, whether it's investors putting money to work. So there is a cost of volatility, and we're seeing that by the declines in the market and the widening out of spreads.
So appreciate this. Thank you so much. Mike Siegel, partner at Goldman Sachs Asset Management, global head of the Insurance Asset Management and Liquidity Solutions business, also co-head of the Client Solutions Group in Asia Pacific. Mike, thank you very much. Really appreciate it. And Sonali, thanks for bringing us Mike, Bloomberg TV global finance correspondent. So if she calls you, you know what it's about. Is this a crisis?
But he says no for now.
He says no for now.
All right, let us know if that view changes.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.